all these shortcomings from our system, which will definitely help us for strengthening the ecosystem. So I would request our colleagues from CIBIL to take it forward from here.
Hi, thank you, Saibal. It was for introducing us, and good afternoon, everyone. So, as Saibal also set the context that we'll be talking about today, the microfinance credit vision algos, and these algos certainly would be helpful not only in credit underwriting, which is right kind of onboarding, but also once the loan is given, the disbursement has happened, then we have to continuously monitor the portfolio, so it will also be instrumental in monitoring the portfolio as well as strategizing our collections, because this product is also how we mitigate the risk. This is all the thing is collection driven, so that is also is of significant importance. So we will see more insights and trends around these algos, which are also the guardrails which has been advised by Sa-Dhan. And with this, I would request my colleague Manu, who is here, to present a couple of slides to us around algos. Thanks, Manu. Over to you.
Thanks, Dolly, and good afternoon, everyone, and welcome to this webinar. Uh, it is a pleasure for all the participants to see here from leading banks, financial institutions, and the ecosystem partners in the microfinance ecosystem uh, for joining us today in this session for MFI CV algorithms. As Saibal sir had mentioned that over the last few years and specifically the 2 decades, this entire sector has undergone a significant transformation. The credit penetration has deepened over the years. Growth has accelerated to high levels of CAGR. Borrower behavior also we have seen as evolving. Considering all those things, the need from the members and the lending community has always been to for sharper risk assessment of the borrower base and portfolio monitoring along with the collections. So since this, considering the criticality of this and the requirement from the lenders, we have we have come up with a new set of product, which is credit vision algorithms. We have seen that the traditional underwriting models often have a challenge to fully capture the dynamic and nuanced repayment cycles specifically for microfinance, because this repayment behavior is pretty different from the normal retail cycle, considering that here we see daily repayments, weekly repayments, fortnightly repayments as well. So this is where the new product, which is data driven CV algorithms, can play a meaningful role. We'll take you through and give a walkthrough about the product, what is the how the product performances we'll check across, and how it can be utilized in your lending life cycle. So just confirm once if my screen is visible.
Not yet.
Yes, it's visible.
Yes, Manu, we can see your screen.
Okay. So we'll go through the in the slide we'll go through the product introduction, the offering, how custom scorecards we can create specifically for a particular lender. So one scorecard would be specifically built for one lender, and that might not be useful for other lenders. So every lender would have different risk appetite and business growth in mind. Specifically for each lender, we can create custom scorecards, and how this credit vision algorithms would be helpful to you, how you can visualize that. For that, we have attached certain sample responses as well. So we'll start with the product introduction. So basically, microfinance credit vision algorithms are a specific set of rules which should be provided to the lenders with borrower insights using trended data. So right now, when we check a specific score or something on the repayment side, we specifically look at how the borrower has behaved today. So score is as of today. So if let's say if you check score of Manu, it would be, let's say 700, but that is as on date when the inquiry is being done. There might be scenario where Manu has come up from 600 score to 700, or has dropped from 800 to 700. So this is the idea, where you get a trended view from on how customer or the borrower has behaved across in the last 36 months or whatever time period he has been live with. So, to identify these behavioral patterns of the borrowers for assessing the ability dimension of the credit risk, these credit vision algorithms would help you. These are historical trended algorithms. So, from the time of the account getting opened till today, if it is, so microfinance, usually the tenure is mostly 24 months. So we go back to 36 months and give you a view of a historical trend to basically identify both, if there has been, if the borrower has certain credit risk, or borrower has been behaving good, and you can identify an opportunity there for upselling for the same customer. So these credit vision algorithms are specifically also built for policy advisories and regulatory norms for the microfinance industry. In the upcoming slides, we will have a look at the certain cohorts like guardrail cohort, which have been released by SRO in the last 1 to 2 years. We had seen certain guardrails have been released, certain norms were there for the industry. We have uh, in created a cohort out of all those norms which are based on the credit lending perspective, and now that you can ingrain it within your credit information report. There are multiple cohorts of algorithms. We have a repository of more than 150 algorithms. You can choose 5, 6, 10, 20 set which are spread across risk, current balance, the utilization of balance, the historical trend on the repayment. There are multiple cohorts. So as per your requirement, business and risk appetite, you can specifically select certain cohorts. We will go through specific cohorts as well in the upcoming slides, and will provide you an information on how these cohorts have performed and how much risk could have been saved. So this microfinance credit vision algorithms, it is for enhancing and enabling the lenders across the lending life cycle, be it at the underwriting stage or in the uh, portfolio monitoring while you do the cross selling or the upselling. And it also helps you building collection strategies. So when you see an increasingly competitive and risk inherent environment, specifically when we have seen last 2 3 years where we had seen good growth before that, and then suddenly last year we had seen the delinquencies were had were been growing across the entire industry. So this product, which is microfinance credit vision algorithms, would help you uh, at the acquisition stage to acquire the right customers. While you do new onboardings, it will help you to acquire the right customers, low risk customers there, and mitigate the acquisition risk. Then at the portfolio management, while you are doing cross selling or upselling, or you want to get an improved product customer fit, you can utilize again these certain algorithms and retain the profitable customers. Eventually, at the end of the lending life cycle, which is the collection stage, again certain prioritization rules and priority list can be derived to get a certified collection efforts or strategies across the collection or recovery. So this is applicable across the lending life cycle. Uh, so what we have observed, and while we talk to multiple lenders, we have seen that a shift is happening from how static checks are being done today, and how we have to move towards a more dynamic credit risk decisioning. It uh, on the retail side, it is already being used by multiple lenders, to get a new approach for credit assessment. While you see today, it is more of a snapshot based underwriting, while what this product enables is more of a continuous or a trend-based credit risk assessment. It will move from borrower eligibility checks to behavior-led borrower understanding, where a comprehensive view of the borrower, how he or she has behaved across the lending life cycle would be understood, and an in-depth understanding will be received through our product. Uh, then from policy-driven approvals and compliance and recent guardrails, you can see this credit risk intelligent decisioning will be can be applied across the life cycle. So this is the shift which requires a new class of analytics, and microfinance credit vision algorithms would help you and your team know across different teams from risk, business, or collections. It would be helpful for the rising borrower complexity and specifically maintaining all the guardrails a lender can utilize during the acquisition time. So now this till now we had understood what is the microfinance credit vision algorithms and how it would be helpful for the lenders. Uh, what are the basic core credit themes on which these algorithms are based? These are balance, trends, and volatility, how the current balance of the borrower moves, the delinquency and the leverage, which we have seen currently, one of the two parameters which have impacted the industry. Then we have the fortnightly repayment, the repayment behavior across last 36 months, and the credit hungriness. What we have also observed that the borrower goes to different lenders, does inquiry with them, and eventually shows the credit hungriness of the borrower, which we can derive through credit vision algorithms. So there are multiple core themes which are based on the credit cycle of the borrower, which are applicable through the credit vision algorithms. Now the key features of this product is that there are predefined templates. For any lender, they will have to check whether a specific set of algorithms, a specific predefined template is already there. In case they want additional algorithms, we can share that as well. So as per their portfolio, their risk appetite, and their policies for the business growth, it the credit vision algorithms allows lenders to use these credit insights and have multiple set of algorithms in a specific template. We can build complement scorecards. So what we have currently, we have MFI score and credit vision score, the CIBIL score. Along with that, we have custom scorecards specifically designed for targeted use cases for a specific lender. Then we can also identify peak delinquency throughout a month. So we have observed that a particular borrower might be at the end of the month might be at 0 DPD, and at the end of next month would be at 0 DPD. But during the month, a borrower might miss their repayments and can show delinquencies throughout the month. But at the end of the month, they are paying. Such type of borrowers who have not been paying in the month have a higher risk while we go forward in the future. So we have included that also as an algorithm. There is an easy BRE creation. It would help lenders quickly create and manage BREs and drive scalable credit policies across multiple products, be it microfinance product or on the retail side, but checking the microfinance overlap of the borrowers, right? So these are the core capabilities which enable smarter microfinance lending through our microfinance credit vision algorithms. Now we move to the product offering. So currently we have, as we discussed, there are predefined templates. One is a guardrail cohort, which is based on the SRO advisory. This cohort will help you assess the borrower, the microfinance borrower, better by identifying the borrower's leverage. So we have seen that in the guardrails cohort, there is a restriction on the number of lenders or restriction on the current balance, right? So it should not go beyond 2 lakh, and the delinquency behavior. So 3,000 rupees overdue amount or 60 DPD on the delinquency side. So all these norms or rules released by the SROs as an advisory have been included in the guardrails cohort. So all these rules would give you a final answer, and based on that, either your BRE or if it is a manual underwriting, the underwriter can check and take decision based on the guardrails output. Similarly, we have a risk cohort. You can specifically spot behavioral shifts before the risk escalates. Specifically, we have seen once the roll forward rates in microfinance have been pretty high. Once the borrower goes beyond 60 plus, the collection rates declines. So basically, such algorithms we have selected and put it in a risk cohort. So these two cohorts are predefined templates for you. You can straight away start utilizing that in the microfinance credit information report and take decisions based on that. Then the third section is custom scorecard. So we have a repository of 150 algorithms based on which a particular lender can build custom scorecards, and this scorecard can be based upon your specific business use case or a risk use case. So if you want, as per your policy, you can create a custom scorecard. This scorecard would differentiate from lender to lender because obviously policies and business growth cycle would be different for each of the lender. So this custom scorecard, we have created a sample template. We'll go through all these templates one by one. First, on the SRO advisory cohort, which was shared with the lenders to tighten the lending norms, what we had seen, there was a lender cap. The maximum number of microfinance lenders was capped at 3. The indebtedness cap was, the outstanding balance was at 2 lakhs. And then lending shall not be happening to a borrower who has a DPD with 60 days or an outstanding of 3,000 rupees. So these are SRO advisory rules. We have, as it is, utilized this information and created a guardrails cohort. So now this is the performance of the guardrails algorithms. So if you see here, I'll go one by one. So how many live accounts are there? How many live lenders are there? And what is the outstanding balance of live accounts? So what we have done, we have taken as on September 2024, which is the light blue bar, and September 25 shows the dark blue bar. The red line is the 90 plus DPD. The numbers are 90 plus DPD as on September 25. So what we had seen, while doing the acquisition, if the number of lenders is only up to 2, right? In September 2025, the delinquency was 4.2%. If the number of lender jumps to 3, this 4.2 moves to 5.3. And when the number of live lenders goes beyond 3, so it might be 4 or more than 4, you can see the delinquency goes twice when we compare it with the number of lenders 3, from 5.3 to 10.6. So it's a clear cut, sharper risk differentiation across using this algorithm, where you can see that the number of borrowers who have number of live lenders greater than equal to 4 are riskier than the ones who have number of lenders at 2 or 3. Similarly, if you see, if the outstanding balance of live accounts goes beyond 2 lakh, the delinquency is at 10.1%. So considering the over leveraged customer causing higher delinquencies while comparing it with the borrowers who have a lower outstanding balance. So we have taken a cutoff of 1.5 lakh, which is basically based upon the 50% FOIR norm for microfinance borrowers. So here also you can see within this 1.5 lakh, the delinquency was only 4.8%, which jumps to 10.1% once the borrower crosses 2 lakh outstanding balance in the microfinance. A similar study we had done for live accounts. If the number of live accounts goes beyond 4, again we can see 2x, almost 2x delinquency from 2 to 3 accounts. if the borrower has in the microfinance segment. So all these values are on the microfinance side. So borrower having 2 or 3 microfinance accounts, borrower having microfinance accounts from 3 lenders, and borrowers having more than 2 lakh current balance on the microfinance side. So these are all microfinance outputs. So these are 3 norms on the in the guardrail algorithms. Plus there are 2 additional norms on the delinquency side. So here you can see if the logic remains same, September 24 population, how the population has behaved in the next 12 months as on September 25. Now here you can see any such borrower having an account with DPD more than 60 in last 12 months. So here what we have seen, we have included only those borrowers who were at 0 DPD as of September 24. So while you are doing an underwriting, at that point of time, the borrower would be 0 DPD in microfinance. But there can be a possibility that in the last 12 months, the borrower would be having a more than 60 DPD account, right? So this is the population. So during the time of underwriting, 5 plus 1 plus 1, which is 7% of the population, had accounts which were having more than 60 DPD in the last 12 months. So September 24 going beyond September 24, so that would mean till September 23. So from September 23 to September 24, there would be certain accounts, there would be 7% of such population who would be having a DPD more than 60. But the lending, the underwriting was done, and going forward in the next 12 months, what we had seen that such borrowers who had such accounts with DPD more than 60 were showing a higher delinquency. So here you can see all those borrowers who had a account with 60 more DPD, 60 plus DPD was having a 90 plus of 12%. While you compare it with 0 DPD borrowers, they were only 6.6% bad rate. So although the population for this 3 plus is less, but if you see collectively from 1, 2 and 3 plus, total 7% of such population were showing higher bad rates while you compare with population who had no accounts with DPD 60 plus. Now similar algorithm, if you see here, here we have added overdue amount of more than 3,000 rupees for borrowers who have 60 plus DPD. Again, a clear risk differentiation that borrowers with more than 3,000 amount were having a 12.5% 90 plus, while with 0 overdue amount were having a 6.5%. So overall, these 5-6 guardrails cohort will help you understand quickly that the customer or the borrower is highly leveraged or has the probability of a higher bad rate or not, right? Then we move to the risk cohort, similar to guardrail cohort. This is a predefined template. We have added here 4 algorithms, which includes the number of instances, number of times the borrower has gone more than 30 plus DPD, has missed payments ratio, breaching a specific missed payments ratio, number of MFI trades written off in last 6 months, or percentage of trades ever delinquent. So these are the algorithms we have taken. And here you can see again a similar type of performance. We have used the same population, September 24 and 90 plus at September 25, right? So in the upcoming forward 12 months, how the delinquency has moved. So here you can see such population who have a written off account in last 6 months. So let's say 3% plus 1%. These 4% of the population had a written off account while you were doing the inquiry. Written off account in the previous 6 months. So for still the disbursement was done, the underwriting was done, and the case was approved. For such cases, we have seen that the delinquency is on the higher side. Again, here you can see 0 return of accounts versus 2 plus return accounts. There's a 2x delinquency with only 1% population. So the population is very minuscule, but the rate of change in the delinquencies is almost 2x. So this credit deterioration is accelerating by 2x across both of these. Here also you can see percentages of accounts ever delinquent. So delinquent here means 30 plus in last 36 months. So let's say a borrower has multiple accounts. So let's say Manu has 4 MFI accounts, out of which 3 accounts have gone 30 plus in the previous 36 months, right? So such borrower, so 3 out of the 4 accounts, which means 75%, such borrowers will fall in this bucket. And here you can see such borrowers will have 9.1% bad rate, 90 plus, while you compare with certain accounts who never had been delinquent in the previous 36 months. Right? Similarly, we have two more algorithms, missed payments ratio in last 12 months. So missed payments would mean that the payment was due in a month, but the borrower did not pay. So total accounts which were due would become the denominator, and numerator would become basically the how many of such due accounts the borrower has uh, missed, right? Similarly, the instances where DPD is greater than equal to 30 in last 12 months. So this is the count of times, instances, count of times when the borrower has gone beyond 30 times DPD. Here also you can see 10% of population is having almost 3x the 90 plus. So basically all these cohorts, all these algorithms would help you understand the risk, the acceleration of the credit risk, and segregate a good customer with a high risk customer. Moving on to custom scorecards, this was the third segment. As I mentioned earlier, this would be specific to each lender. So what we have done here, I'll just take 2 minutes to explain MFI score. So MFI score is a scorecard which will help lenders understand the borrowers, the microfinance JLG borrower, on how they have behaved. So we give a 300 to 900 MFI score, 300 being the highest risk customer and 900 being the lowest risk customer. Such borrowers, just like what we see in the CIBIL score, you can differentiate between borrowers based on this score, right? So here you have seen we have taken a certain population, and after the originations, how the customer behaved in the next 12 months, right? So let's say the disbursement happened in the month of July to December 2024. In the next 12 months, which would be calendar year 2025, from January 25 to December 25, how the borrower has behaved. At the time of doing the underwriting, what was the score while the underwriting was done? This is mentioned in the x-axis. So 65% of the borrowers in that period, July to December 24, were 720 to 900, which is considered to be a low risk score. Such 65% of the borrowers had a bad rate of 6.3%, right? Similarly, on the other end of the spectrum, the high risk borrowers, while doing the disbursements in this segment, 10% of the population where the approvals were happened. Now this 10% had a bad rate of 23%. So here the MFI score is helping you identify the riskier segment, which is 300 to 650, and this is 4x than the average bad rate, right? 4x from the low risk segment bad rate. Here the average bad rate is 12.4%, and also this is nearly 2x of the industry average as well. So this is for a particular time period from January to December 24, let's say, and this 4x, 3x, 2x would change, and this values of MFI score might also change, right? So probably at a time when the industry was going through a turmoil, this number, high risk borrower population would be particularly high and low risk would be less. So that those things can happen, but specifically MFI score would help you identify the riskier segments. Now, considering this, now we move on to the algorithms cohort. So what we had done, taking outputs of certain algorithms, the output, so let's say number of lenders, only one, that goes in CV segment 1, and number of credit lenders in microfinance is, let's say, more than 4, so that would go into CV segment 5, right? And multiple such algorithms goes into each segment. We have taken multiple algorithms from that, and those we have created segments out of these algorithms. Now individually, this algorithm again will give you a sharper risk differentiation. So here you can see CV segment 5, which would be riskier output of the riskier algorithms, right? It can provide 35.7% bad rate differentiation, and while you compare it with the lowest risk segment, the bad rate is just 4.2%, right? The population of segment 1, which is the lowest risk segment, this is 37.2%, and segment 5 is 4.2% population. So these segments we would help you for your particular portfolio as per your policies, as per your business growth. We can help you create these CV segments, which will, as an example, here you can see 4.2% of this population is giving 35.7% of the bad rate. So you can take decisions on how to treat this CV segment 5, or as per you, if your risk appetite is less, you can also take a call or add risk mitigants in the CV segment 4, right, which is also higher than the average bad rate. The average bad rate for this population is 9%. So this CV segment 4 is 14.4%. So again, if the lender has a lower risk appetite, they can take decisions on this 14.4 plus 17. So basically 21.7% of the population they can take and add risk mitigants in these two populations and try to build, do cross selling or upselling from the CV segment 1, 2, or 3, which are the less stressed segment once while we compare it with the CV segment 4 or 5. Now what we had done, we had understood MFI score, then the segments from the algorithms. What we have done, we have overlaid both score and CV segments so that to identify a higher stressed population. So here you can see this population was 4.2%, while we add MFI score along with that. So this is the population distribution. Here you can see on the first side. So 100% population along with MFI scores 300 to 900. So this 3% population, which is coming from CV segment 5 and having an MFI score of 300 to 650. This is the highest risky segment. If you come to the performance of this population, 3%. Here you can see the bad rate is 9%, total average bad rate, total bad rate of this population, while the bad rate of this population, CV segment 5 and 300 to 650, this is 42%. So almost 4.5x times bad rate from the average, right? And on the contrary, if you see from 800 to 900 score and CV segment 1, this has just 3.5% of the bad rate. And if you see on the darker shades of green, 3.544%, this is almost 30 plus 1.3.3. So basically almost 32% of the population is coming from the lowest stressed segment. So as per your policy, you can specifically make cuts on which. So basically, if you see light brownish kind of segment, this is also a population on which you can take a call. Again, a yellowish segment, and then the light greenish segment. So as per your requirement, you can create certain cuts based on your, if you want to drive business, you can push on this numbers, controlling risk from this segment. So right, so this is the swap out population where 3% of the high risk accounts have almost a 42% of the bad rate, while the average bad rate is 9%. So these low and very low segments, the medium, low and very low, would be segments which would be low stressed while comparing with the very and high. Right. So now how to approach and identify these potential borrowers and how TU CIBIL can help you on that. So currently you have a MFI portfolio base, which is 100% of your population. We had seen how to, understand the risk assessment using segments by microfinance credit vision algorithms and MFI score. So combination of both these can help you lower your credit cost and do a sharper risk assessment. Then we can help you with the affordability indicator, which is provided by the lenders on the household income and the EMI to compute the the obligation to income ratio. This will help you lower your acquisition cost. Then we have a propensity score in case there is a need for borrower cross-selling or upselling. That can also again help you in understanding how and which borrower to be targeted. This will help you lower your marketing cost. Eventually, you will be left from 100% to, let's say, 20 to 30 to 40%, whatever your rules are as per your custom scorecard. You can come to a definite target borrower segment, which will help you understand and identify those potential borrowers. Specifically, you can choose to cross sell or upsell. So cross sell from MFI to retail, probably business loan, personal loan, consumer durable loans, such type of retail loans we have seen having a high overlap on from the microfinance base. Or even if you want to keep it on the microfinance side, you can still push the disbursement amount from, let's say, 25 to 40,000 or 40,000 to 60,000, or move into the next cycles for the borrowers by giving an additional amount. So based on that, you can do cross selling and upselling. So how you would get these actionable insights in your report? So here you can see this is a sample PDF response. I have just attached it here. So let's say total past due amount of currently 60 or more DPD trades. So this is the amount. So 23,394, right? So if you have a rule of 3,000, this value would be breaching that rule, right? If you have a specific rule of number of open MFI trades, so while during doing an inquiry, you see that a borrower has 6 MFI trades currently live in the MFI industry, you can set this as a rule. Probably you can have it at 4, 5, or if you're comfortable with that, you can have it at 7 as well. Then again, total count of lenders with open MFI trades, this is again 4. So in case this breaches 3, so this is a guardrail cohort we had shown earlier. This is just a sample output how you will get in the response. So you can see there are 4 lenders currently for that particular borrower. And then we have the balance for active trade. So what is the total current balance for that particular borrower? Here the borrower has breached the 2 lakh current balance amount. Currently the borrower is at 3.42 lakhs current balance. So all these values, the user, the underwriter, or the system can read, and based on that, if you have a specific BRE, you can specifically build rules on these algorithms, the output of these algorithms, and help your underwriting team to create specific decisions or add risk mitigants basis these algorithms. So we have these algorithms based on the microfinance sides. We have standard set of credit vision algorithms on the consumer side as well. So this is the list of that, and we can create specific algorithms from consumer and the microfinance side specifically for each of you based on your portfolio and business growth. Again, in case you are taking a API from us, this is a sample response, an XML response, which again, this is MF01S. This is the algo you would have subscribed to, and this is the output value of that. Similarly, MF02S is the name of the algorithm and the value. If you have a JSON response, again, similar feature name would explain you the algorithm name and the value of this output. So value 3, 1, 4 are the same what we are looking at the value output here in the PDF or the HTML file. So these are the responses which you would get while you connect with our API kit, or a PDF would be available in the web response or the API response as well. So whichever response you are comfortable with, your BREs, your system, or your underwriter, if you're doing it manually, you can get the responses, and based on that create rules specific to your norms. And we have predefined templates to follow. If you want to follow the guardrails cohort, you can specifically take the guardrails cohort and embed it in your CIR as well. This is all from my side. We are opening the forum for Q&A. So if you have any questions, we can take the
Hi,
question.
Manu. Jagdish here.
Yeah.
Yeah. See, these algorithms are rule-based algorithm, or is it something different, like ML-based algorithm?
So these are all rule-based algorithms. As I had shown. So basically, whatever submission happens through across the lenders, we use that data, and based on that, certain rules are created. So all these 150 algorithms are all specific rules. We would provide an output of the rule. So let's say number of credit lenders. We can provide that the borrower has 6 credit lenders live currently. You can create a rule in your system whether you are comfortable with 6 or you are comfortable with 3.
Actually, sir, hello.
Yeah.
I'm Joshi from SFMS. This algorithm what you have shown, whether do you have the algorithms based to gender, area, and activity-wise or something like that, so that the loan given, if MFI is not across this country, it is restricted to some area. Some
Okay.
MFIs are giving loan to some areas. So it is restricted. Second, the repayment pattern in rural and semi-urban, urban differs.
Yes.
And third one is the men to woman, the repayment criteria differs. So if you have input for these things, it would be better for MFIs to lend, because most of the MFIs are lending at the rural level and to the SSG groups.
So on the gender point, we had seen that 98% of the population are all female borrowers. On the microfinance side, 98% of the borrowers are all female borrowers, and hence there won't be much differentiation for that the rest 2% who would be, let's say, male. So on the gender point, currently we do not have any algorithm specific to any demographics, IDs or that. Currently, we do not have algorithms. These algorithms are all based on the repayment behavior mostly on the of the borrower on the microfinance side. If you want to check how, in case you're also on the geography side, if you see, almost 80% of the population is semi-urban plus rural. So Suru region, what we define as, out of 100% in MFI industry book, 80% is Suru book. So currently, all these algorithms capture how the borrower has behaved on the loans which have been provided to them in last, from 2017 or so. So from that time period, we have this information available with us.
Thank you, sir. One more last question.
Yeah.
The data collected is from which place to which rate to which rate?
Sorry, I didn't get you. Can you?
Data collection.
Yeah.
Can you tell me the period of data collection?
So data collection to the bureaus you are asking?
Yeah.
So data collection happens on a regular basis. All the
No. Sorry, sir. I'm asking the graphs that you have drawn.
Yeah.
Is based on some data.
Okay.
So from what period data you have taken to draw these graphs?
So this was from July 24 to September 24 originations we had taken. I'll just showcase it again. So this population is July 24 to September 24 originations. So this is the quarter on which we had done this study. So obviously once we do a study on another time period, the numbers would slightly change, but the bad rate, what we had observed, is consistent across all time periods in the last 3 years.
Your study is restricted to only CVs, no?
No, this is across both MFI score and CV score, both.
Thank you, sir.
Yeah.
Hello. Hello, Mr. Manu. This is Silva from LOLC India.
Yes, ma'am. Go ahead.
This parameters which you have taken for scoring the customer, so the data will come as on the pull date, right?
As on the pull date. That's correct, ma'am.
As on the pull date, it will show what is like if how many number of MFI lenders, any outstanding, but it will not give any trends, right? Is any trends will be available?
Yeah, ma'am. So for that, so basically we have two segments. One is while you are doing the underwriting, you do an inquiry, pull a report. That is the current as on reported date. We have offline segment as well, which is in the industry it is known as batch, PR, or scrub. So you can do a scrub, and for any particular date or any particular month or any trend you want of a specific algo, you can take that as well. We would provide for a particular set of borrowers, if you can provide us which is the borrower segment you would like to have a view on, we can give you a retro information as well for those algos.
Okay.
So that retro information with us is already available from the year 2022 till 2026.
Okay, thanks.
Welcome, ma'am. Any more questions?
You will be sharing this PPT with us with the participants?
Yes, ma'am. We can share this PPT. That's not a problem. We can share it.
Yeah, please share it. So we can just go through again. Okay, and if we have any specific questions, then we can come back to you.
Sure, sure, ma'am.
Thanks.
Sir, one last question, if you don't mind.
Yes, sir.
For this scrub data, you have taken the data from the last 24 months credit history, correct? Or 36 months?
Yeah.
How much you have taken, sir? 36 months, sir?
So the trend we can provide you to, so every algorithm would be certainly a little bit different. So let's say count of lenders, we can provide you at the time. So basically as on date, how much number of lenders Manu has exposure to. So that would be 4. So this will go, I will go and beyond check 36 months. So more or less for most of the algorithms, the timeline would be 36 months.
Okay, thank you, sir.
Welcome. Any more questions? We can take them. We'll share the PPT across.
We'll take the PPT from CIBIL and share with all the participants. That's sure. Any other question from anyone? Or we can close the webinar maybe. Any last question from anyone? Thank you, Manu and Dolly. Thank you, the CIBIL team, for this PPT and the information on the credit vision algorithms. It's really helpful for our members. Thank you for coming for this webinar on a short notice. And thank you, participants, for joining us today. We'll circulate the PPT with all of you. If you have any query, you can share with us. We'll forward it to the CIBIL team.
Thank you, everyone. Thanks, Sa-Dhan, for arranging this. Thank you.
Thank you, everyone.